for very destabilizing things have just happened. So the price of oil pick up about 20% off the lows, 20% off the lows. You had the Bank of Japan widen out their yield curve control on JGBs. You had the US get downgraded. And then you had the US Treasury come out and update their borrowing estimates to note that they're going to borrow almost $1.9 trillion in the back half of this year. And when you put all of these things together, they are a very toxic combination that we wrote at the time and still believe are likely going to drive global capital costs up, potentially non-linearly. In other words, Treasury yields, global sovereign bond yields up non-linearly at a time when the world really can't afford that.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. America is currently running an annual deficit at 9% of GDP. That's an extremely high percentage historically. We've practically never run a deficit this high with unemployment this low. We're essentially running a wartime deficit in a peacetime economy. And a big part of this deficit is the ballooning interest costs we're paying on servicing our national debt, as interest rates have spiked from near zero at the start of last year to over 5.25% today. And it doesn't help that tax receipts are falling versus last year. As a country, we're bringing in less income and spending more on debt interest. Today's guest, Luke Gromen, has been loudly warning that this dynamic is resulting in a sovereign debt crisis, not just in the US, but in many other major nations around the world that are in a similar boat. What could such a crisis mean, and where are we in its timeline? To find out, let's hear from Luke himself. Luke, thanks so much for joining us today.
Thanks for having me back on, Adam. It's great to be here.
Hey, always a pleasure. Lots of questions for you here, Luke. Let's jump right in, but to kick it off at a high level, let me ask the question I like to ask you every time you're on the program. What's your current assessment of the global economy and financial markets?
I think the best way to frame the assessment is something we wrote about for clients 3 weeks ago, give or take, which is that four very destabilizing things have just happened. So the price of oil pick up about 20% off the lows, 20% off the lows. You had the Bank of Japan widen out their yield curve control on JGBs. You had the US get downgraded. And then you had the US Treasury come out and update their borrowing estimates to note that they're going to borrow almost $1.9 trillion in the back half of this year. And when you put all of these things together, they are a very toxic combination that we wrote at the time and still believe are likely going to drive global capital costs up, potentially non-linearly. In other words, Treasury yields, global sovereign bond yields up non-linearly at a time when the world really can't afford that. And so I think that is ultimately going to be very destabilizing. It's going to bring us back toward a regime of what we saw April through October of 2022, which was dollar up, everything else down, gold flattish, everything else down, with a potential kicker of oil up. So a very tricky environment that I think will ultimately accelerate and pull forward the Fed being forced back into QE or Treasury being forced into liquidity moves despite rising oil prices and rising rates and accelerating sequential inflation. So it's going to be an interesting fall, winter, and into next year, I think.
Okay, so what I hear you saying is it's nothing but sunshine and roses ahead.
If you own oil and gold, you might see it as such, but if you own dollar, maybe you'll see it as such. But other than that, it can be a little tricky.
Okay, we're gonna get to discuss this in depth, but just to pull in a preview for folks, when you talk about Fed having to step in, QE, maybe cutting rates, that type of stuff in response to this toxic cocktail that you just mentioned, do you have a general timing for that? Is that something you see happening by the end of the year? Is that something that's in 2024 later?
Well, we know Treasury's coming in with Treasury buybacks in 2024, right? So they say that's not going to be liquidity adding. They say that's going to be relatively small. Let's see. So that would be, that was something I got wrong last year, which is I said that the Fed would be forced into liquidity to resume liquidity injections by the end of third quarter 2022, and that was wrong. It was wrong because Treasury did it. It wasn't the Fed. Fed kept tightening. Treasury loosened.
Sorry, let me interrupt you there, because this was exactly my next question for you. Literally citing when you were on the program earlier in 2022, thought that the Fed would be forced basically to have to stop the interest rate hikes by Q3 of 2022, maybe even be forced to pivot. So my big question for you is going to be, what happened? And really, back then, when you made that statement, we were under a 3% federal funds rate. Here we are today, fast forward a year later, basically, we're at a Fed funds rate of 5.25%. How is the system still running at a cost of capital this high, given the concerns that you had flagged a year ago?
Sure. The answer is not very well, right? So like I was just saying, the Fed didn't stop, but Yellen more than offset QT by running down the Treasury general account late last year. In the fourth quarter of last year, the dollar fell at a 40% annual rate. And all else equal, weakening the dollar keeps the system together. It adds liquidity to the system. It adds upward pressure to asset prices. It makes FX hedged Treasury yields more attractive for foreign buyers to buy. And so all of the things that we were seeing that we thought would force the Fed to pivot by the end of September, basically forced the Treasury pivot right around the end of September, maybe 2 weeks after. So that weakness in the dollar from late September on, driven by Yellen running down the TGA in no small part, bought time for the system. The US banking system effectively saw severe strains in March, obviously. And the Fed, once again, Fed's got a great PR. BTFP is not QE. Okay, great. They're growing their balance sheet again. They are effectively doing a soft form of yield curve control by writing up the value that they will lend against treasuries relative to the market. They are basically capping treasury yields by BTFP. So the Fed did get involved there. They have the BTFP numbers are still at near their highs. They have resumed. The Fed have resumed QT. And that then brings us into the second quarter. So we have BTFP, liquidity injection, calm the system down. The banking system was breaking. And to be clear, it wasn't necessarily a banking system problem. It was a treasury market problem, which was exactly what we talked about. It's a supply-demand problem. It's a fiscal crisis. And the banks were upside down. And so the Fed could have said, look, we're not going to do anything. And if they wouldn't have done anything, SVB, great. Hey, Oprah, you had 800 million in unsecured deposits or whatever she had. Bye-bye. It's gone. Billions of venture capital out there in California with you sitting at SVB. Bye-bye. It's gone. Oh, you got to lay people off. Sorry, lay them off. Oh, you got to crash the housing market as all those people sell their homes because they don't have a job. Good. Lay them off. Now, I don't think that's what they should have done, but the Fed had that opportunity to do that. And I've always said, we're not operating at dial anymore. It's a switch, off, on. There's no little soft. They want to stop inflation. That's what they needed to do. So we had the strains. They come in, they paper over BTFP, etc. Second quarter, we run into the debt ceiling. which is wonderful because there's no issuance. The area of the crisis, it's a supply demand problem in treasuries, and the supply stops. So we, that plus AI, where we get this sort of narrative of, hey, AI's, going to change the world. And I think it will ultimately change the world, but it isn't going to change the world in the second quarter of 2023. And I think people probably got too negative. I think expectations got too negative relative to what happened given that. And so you had sort of this rally, you had no issuance, everything kind of stayed contained. And then we passed the debt ceiling, we get into the third quarter, and we have these four destabilizing things. And I think a critical moment in this whole process was June 1st, give or take. Goering Rosenzweig came out, highlighted the US shale is starting to roll over, and it's going to roll over in the back half of this year. And so the Fed and the White House, they can play all these games they want. They can't print oil. And so now oil prices are starting to rise on them, and these other issues are starting to hit. So I think that is sort of the sequence of events that, from last fall where, they weakened the dollar, they bailed out the banks, there was no treasury issuance for a good chunk of a quarter. And, now all those things are going the other way. Here we are.
All right. Great explanation. I'm curious, just building off of what I said in the intro here of how high of a deficit that we're running. We've got the spending from the Inflation Reduction Act that's now finally coming into the mix as well. But we are, I think we currently have a 1.6 trillion deficit right now. You just mentioned that the Treasury announced that it's going to borrow like another 2 trillion in the second half of this year. I imagine just the general kind of excessive deficit spending also kind of helped buy some time. It's sort of another form of stealth liquidity out there in the system. True?
Yeah, it's helping to inject liquidity into spending and liquidity into the system on some level. Particularly in a time when there was no issuance on the other side of it.
Right.
In the second quarter.
So I've mentioned this a couple of times. I'd like to get your thoughts on it. A couple of times recently on this channel. So we have the Fed jamming on the brakes, right? That's what it's trying to do to get inflation back down to 2%, right? We have the banking system putting its foot on top of the Fed's foot there, continuing to press the brakes even harder. Banks are doing that because they're tightening lending standards, not necessarily because they care about inflation. They're fighting for survival. They just want to have less bad loans, right? Given their fragility right now. But on the fiscal side of things, we're jamming on the gas, right? What are how long can that persist for before you start creating undesirable consequences? And to a certain extent, the Fed has got to be looking at the fiscal side of things and saying, guys, what the hell? You're undoing everything I've been trying to do for the past year, right? So can you comment on that mismatch right now between fiscal and monetary policies?
Yeah, it depends on what side of the house you're on, right? As to what's undesirable, right? What's normal for the spiders, chaos for the fly. And so when you hear the US government saying we have these geopolitical goals or imperatives in Europe with Russia, et cetera, when you hear the US government say we need to move away from China, we need to reshore our productive capacity, or we cannot produce shells to support an industrial war with a major power, because our industrial base has been so hollowed out over the last 25 years. You need to spend, you need to inflate, you need industrial policy, you need all those things, all that fiscal, that has to happen. So the DOD is like, hey, great, do it. Treasury is saying, hey, I've got, I need the strong dollar to try to place this paper. And the Fed's saying, hey, I need low inflation because otherwise, Jerome Powell's legacy is going to be destroyed. And the Fed's credibility is going to be destroyed. Look, the last 30 years, the winners have been the Fed, Wall Street, and China, not America. DOD is like, listen, we can't fight a war. We're borrowing money from China to build weapons made in China, with components made in China. This doesn't work. And so it really comes down to, the Fed and Treasury are trying to preserve the strong dollar for the primacy of the bond market. It's no longer in the interest of America. Or if you want, you and I tweeted about this yesterday, you can have one of two things. You can have a strong dollar, low inflation, low rates, in which case you are not going to be able to pursue the geopolitical policies that America is trying to pursue. Namely, the United States will need to buy components from China to build the weapons to encircle China if we have a strong dollar, if we have low inflation. If you think that's a bad thing, then guess what? The bond market has to get killed on a real basis in inflation-adjusted terms, because what has to happen is we run 10, 12, 15% of GDP deficits, and the Fed makes noise and tries to tighten, blah, 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 until rates get too high. And once rates get too high, the Fed faces a choice. Dear Jerome Powell, do you want to keep raising rates and keep money tight and force the US government to make 40 to 60% cuts now permanently to defense and entitlements, because those are the only two things you can cut other than Treasury spending to stop those deficits that matter, and nothing else matters. It's entitlements, interest, defense, in that order. So, Powell, do you think your legacy will be helped by cutting entitlements and by cutting defense tomorrow permanently by 40 to 60%, which is what Stan Druckenmiller estimated needed to be cut in his presentation out at USC a few months ago? Or are you going to do your job in situations like this, the job that the DOD wants you to do, which is buy the paper, cap yields, do QE, finance it, and do what's best for America in the long run, rather than what's good for bonds in the short run and good for Wall Street in the short run? And that's the decision. That's some version of that's going to play out over the next couple of years. They got to make a choice.
So where does inflation and cost of living fit into all this? So in other words, if the deficit spending keeps, going on for as much as it is, that is inflationary, right? Mm-hmm. The average person is feeling the pain pretty strongly right now. It's a big part of what's driving Powell to protect his legacy. I don't want to be the Arthur Burns that just let inflation run wild, right? The administration has I'm sure, they want to please the defense industry and deal with some of the things that you were talking about, but at the same time, they want to get reelected, right? They don't want to be going into the voter booth with inflation resurging, right? So, yeah, there just seems to be so many cross currents here. I don't really see anybody can kind of have their cake and eat it too, no matter which policy they pursue.
No, and it really comes down to, look, for the last 40 years, bondholders and Wall Street and China won, and Washington, D.C. That's who got richer. And the working class and the middle class America got poorer. And we have to decide if we want to continue that to its natural terminus, which people in the Rust Belt of America can tell you is we can't buy anything that ain't from China, right? So that's the part I find that the coasts of this country don't recognize, that in particular in the East Coast, that China can win. China has won in the middle part of this country. And those parts of the country need to decide, do we want to maintain the real value of our bonds, or do we want to actually compete? And the outcome to that, if they decide they want to compete, is that yes, it's going to be wildly inflationary. Yes, if you own a lot of bonds, you're going to go from wearing diamonds to wearing cubic zirconia to wearing Cracker Jack on a string. You're going to go from eating filet mignon like you have for the last 40 years to eating dog food. Sorry, it goes the other way. The flip side is the people that lost for the last 40 years, U.S. middle class, U.S. working class, they're going to win, right? Quote unquote win. Yes, inflation's going to go up, but look, everybody's got a 2.9% mortgage. If their wages go up 15% a year, are they winning or losing?
All right, I'm going to want to dig into this more with you, but let's let's keep going through this arc here. So still staying at a relatively high level, you have, I think for a good long while now, beat the drum of the global sovereign debt crisis, right? We're basically, countries are getting to a point where the cost of servicing their massive piles of debts really become constraining just for the general operation of the nations themselves. If I remember correctly, you said the U.S. What is it? It's either like, get busy defaulting or get busy inflating, I think is what you said, right? If I'm remembering
Something
correctly.
like that. That sounds right. Yeah, from Shawshank Redemption. Yeah.
Yeah. So, we've talked kind of about what's happening right now in this moment in time, but zooming up to a very high level for a second, where are we in the timeline of your global sovereign debt crisis? You're from a family of baseball players, kind of what inning are we in, and where do you expect this to go probability wise? Both U.S. but also relative to the other major powers.
Yeah, sure. I would say we're probably in the 7th inning, maybe the 8th inning.
Wow, it's so late. Okay.
And the reason I say that is quietly in the first half of this year, fiscal first half, right? So that is 4Q22, calendar 4Q22, calendar 1Q23. Those 6 months of the U.S. government's fiscal year, after, that would have been 6 months of tightening is the starting period of that, maybe 7 of the Fed tightening. And with rates way lower than they are today, by the way, and before the effects of those tightening has really been felt, which is starting to be felt, U.S. true interest expense entitlement and Treasury spending was above Treasury receipts. The U.S. government on a full year basis, after just the first 6 months of tightening, before all the effects really were felt, and before the interest reset was fully done, was already in a position where the U.S. government couldn't afford what's effectively its true interest expense out of tax receipts. You're done. And that's like, I'm fascinated to see people say, well, I want to buy long-term debt here. Okay, great. But to me, long-term treasuries, long-term really any debt, it's like picking up nickels in front of a steamroller. You might get some, and maybe you can have a trade. I don't have an opinion on that. But you don't do well in this business long-term picking up nickels in front of a steamroller. The U.S. government can't make its interest payments without the Fed printing the money. Why get involved? And that's why I say we're in the 7th or 8th inning. Like that was it's almost September, so that was 6 months ago. So yes, stocks are up in the second quarter. That'll buy you some time on the receipt side. Now, with that said, April, May receipts were a friggin' disaster. So on a trailing 3-month basis, year over year, U.S. Treasury receipts were down 20% through May. There only been, I think, 3 other times in the last 40 years, they've been down 20% year over year. It was.
Sorry to interrupt, but I'm just curious, how much of that shortfall is because my state has pushed out its tax payments until, I can't remember exactly when, but later this year?
Yeah, like October. That's got to be a good chunk of it, right? So I think California is 15% of payments. So if you assume that California was flat year over year, which is a heroic assumption because California is California's income is very asset price driven, and asset prices had a disastrous 2022.
It's very true. Yep.
So if you make the heroic assumption that California was flat, which your own budget would tell you there's no friggin' way, given what the deficit out there has done, it would still be down 5. Right. Okay. That would keep. So it would have been down 5. So it's probably down 8 to 10 with California. You will see a pickup a little bit later this year, but the bigger point is that we also haven't seen the interest expense. Interest is going to keep resetting and keep resetting and keep resetting. And the more the long end goes up, receipts are gonna fall. And we're in sort of a Mexican standoff on the housing market, right? Where people that are in 2.9% mortgages don't want to sell, blah, blah, blah. Yep. Those will, I don't know when, but that, unless you get much lower rates, those will reset lower and tax receipts will keep. So It's only the one piece of two pieces of good news. California, you're going to have a one-time benefit, assuming they don't give you guys another break with these floods and stuff. And then number two, you did have, markets are up year to date. And so all else equal, if they can keep markets up, that'll help. That'll help as we go to next year. But sort of everything else, it's only going to get worse.
All right. And it's only going to get worse under current trajectory. Now, there's a lot of people, just to your point about bonds, and we'll talk more specifically about bonds in a bit. But on the bond side, they're saying, "Oh, I agree with you, Luke. Like, it's going to get nasty." And as soon as the Fed is able to, like, once it feels like it's got inflation under control, it's going to pivot, right? Or these high rates are going to, and lack of inflows, they're going to start causing some bigger systemic breakages that we've seen to date. And whatever inflation's at, Fed's going to say, sorry, I got to forget that battle for a bit. I got to save the system, and we'll pivot. So, I think the argument for people that are piling into the long bonds, which in your opinion right now is going after nickels in front of the steamroller, they would say, and I'm not saying you have to agree with them, but I'd like to hear your response. They would say, no. We know that the system, the higher rates are going to win at some point in terms of breaking the system, and the Fed's going to be forced to pivot. And that's why we're piling into the long bonds, because we want to ride the reduction in yields once the Fed starts buying.
The problem is oil's $85 and US shale's rolling over, and US shale has been 90% of global production for the last 10 years. Energy inflation will explode higher if they pivot. So, yeah, I mean, you could probably make money doing it. They might be right, but like, to me, it's such a suboptimal expression. I would much, if that's going to happen.
Sorry, can you just explain why the Fed pivot would cause energy price inflation to skyrocket?
Oh yeah, because you're going to be stimulating the economy by cutting rates into declining oil supplies.
Got it. Okay.
Yeah. So now, it's, when I look at that, I hear that, I say, okay, great. What long bonds do you want to own if I told you oil is going to be, 120 under that scenario? And the answer is probably none of them.
Mm-hmm.
Because if you look at inflation break evens against oil prices, it's like, 5-year US inflation break evens against oil, it's like perfect correlation. And oil's going up. So it's like, and Powell and the White House SPR releases have broken US shale, and US shale was 90% of oil production growth over the last 10 years. They don't know what they did. They don't realize it. It was I recently called it the piece de resistance of penny wise, pound foolish policies after 35 years of penny wise, pound foolish policies.
Okay, and just to kind of pile on that particular worry spot, we've had oil and natural resource specialists on this program a fair amount, and they have all said that we have underinvested in CapEx in this space for a long time anyways. But now in the past couple of years, with the whole, green movement and whatnot, the fossil fuel companies have been getting the message from Washington that, like, hey, we kind of want to put you guys out of business. So they've had a real disincentive to continue to invest, because they don't know if what the conditions are going to be like for them to get a return off any big investments they're making today. So, as Rick Rule has said several times in this program, he's like, even if demand just stays flat for the next decade, which it won't, it's going to go up. But even if it just stayed flat, we are already going to have pretty big shortages of a lot of these, well, certainly oil, but a lot of other key resources, because of decisions made 5, 10, 15 years ago to not invest, right? So it's just going to compound what you're talking about, likely to compound what you're talking about. And
this is why it's so destabilizing. If you look at US oil prices relative to 5-year bond break evens, your inflation break evens, right? They're like 1-to-1. They're very tightly correlated. So if oil goes up, bonds are going down. Like that. Okay. So that's the issue. So, and we had some control over that while we had a shale industry, but thanks to Powell and thanks to Biden, they just put a bullet in the shale industry's ability to grow production for the next 2-3 years. So guess who's in charge of oil? now for the next 2 to 3 years. Putin. What do you think he wants to do to the U.S. bond market? You think he wants the U.S. bond market to have a good time?
No.
Come on.
Yeah, no. Got it. And just for folks to understand, the reason why I talked about how the administration is sort of sending signals to the oil industry that, like, look, we want to try to replace you guys over time with green alternatives. The reason why you're mentioning Powell killing the shale fields, as I understand it, is it really what enabled the shale revolution to happen in many ways was the cheap credit that was out there.
Yeah, there were three things to shale, right? It was the steerable lateral technology that really allowed productivity to rise. It was expensive oil, which was a function of cheap money, and it was cheap money.
Cheap money's gone.
The cheap money's gone, and there's some geological issues here as well. The A locations are largely gone at these price ranges of oil. At the A fracking locations, you're down to your B and C fracking locations that they just aren't as productive, which means your break-even costs go up. So that's the connection that there's part of what I do at FFTT is try to go across silos, right? There's and so there's like the siloed bond world that's looking at back to your original question of like, what would I say to them? They're in their silo and they're saying, yeah, hey, every other time they break something, and then people bid these bonds. And the people who are over here in the energy silo are going, guys, like, there's no friggin' supply growth. Like, and something we've noted historically, again, I said 90% of global oil production growth roughly has come from shale over the last 10 years. So if we take that offline, if they just stop drilling, U.S. oil shale is going to fall by 20 to 30% annually after a bit of a lag. Rig count has rolled over. The thing that the people on the bond side aren't getting is that the worst recessions in history, going back 70 years, saw global oil demand fall by 4% in 1980. As nasty as that recession was, global oil demand only fell 4%. In 2020, when we shut the friggin' economy down globally, basically, global oil demand fell 8%. And I just said 90% of global oil production growth over the last 10 years is going to fall 20 to 30% on a sustained basis. So like the energy silo is going, guys, hello, McFly. And the bond guys are like, hey, they're going to break something, and they might be right. That's why I say it's a trade. It's picking up nickel in front of a steamroller. Could they might very well be right? And then the energy silo is going to take over, and Enter's going to be 150, 160, 170, 180. And like, there's no long-term bond you want to own. If I said oil is going to be 150 a year from now, would show me the list of long-term bonds you want to own? The answer is none of them. Not at these yields.
All right, got it. And I think you just answered this, but there are people that would raise the question, well, okay, look, if this high cost of capital, these high rates gets to the point where things are breaking, right? And we finally, you intimated this earlier, but I would love to talk about it with you a bit. We finally start really seeing the lag effects arrive in full force, right? A lot of the stimulus that you and I talked about earlier, right, that came from the Treasury and the deficit spending this year, the stimulus that wasn't really on the radar in 2022, right? It pushed out the recession that everybody thought was going to come, right? But did it dissipate the recession, or did it just push it off into the future? I think you would say, correct me if I'm wrong, it just delayed it. The lag effects are going to come. They're going to be big and real. So could that throw the economy into a substantial recession? And if so, people would say, well, that will bring down demand for oil and we won't have to worry about high oil prices. But what I just heard you say is like, not really. I mean, recessions don't necessarily knock oil demand down as much as you think. Then again, the relationship between demand and price in oil sometimes is a little wonky. So anyways, what are your thoughts on all that?
It would depend on the speed of the recession versus the speed of the decline in oil supplies, right? So ultimately, the decline in oil supplies is going to win. But initially, absolutely. I mean, we saw that in April 2020, oil prices went negative. That kind of thing can happen, but it's not sustainable for a number of reasons. And this gets back to the point too that I think on the bond side, people aren't paying enough attention to is the U.S. net international investment position, right? So let's say they're successful in getting oil prices down. Let's say they fight inflation, they get the dollar up. Well, the dollar going up is going to force foreigners around the world, as we are seeing, to sell dollar assets to buy dollars, to get dollars, to service dollar denominated debt. Well, foreigners own $7.5 trillion in US treasuries. And we know the US Treasury needs to place just short of 1.9 trillion in the second half of this year alone. Who's a buyer? Who's a buyer for that amount of paper? Not the banks anymore. They were buying, they and the Fed were the buyers for the last 2-3 years. Banks are out, Fed's out. So what are we going to do? Simple. We're going to find the rate where there's buyers. But that doesn't make bonds go down. And that's like, it's literally happening on people's screens and they just refuse to believe it.
Yeah.
Because it's never happened this way before, because they're ignoring the net international investment position.
Yeah.
You know, the thing that people are missing is that up to 2008, the US net international investment position was never more than negative 10 to 12% of GDP. In 1989, when Japan blew up, right? Peaked and rolled over. US net international investment position was negative 2% of GDP. US debt to GDP was 50%. US debt to GDP is 120%, and the net international investment position is negative 65% of GDP. It means foreigners own $18 trillion net, not gross, net of assets they can sell if the dollar gets too strong. And they will sell them, and they are selling them. And when you need cash, what do you sell? You don't sell what you want to, you sell what you can. What can you sell? Treasuries. They have 7.5 to go, 7.5 trillion.
So there'll be a lot of downward pressure from the sales. I hesitate to ask this question because it opens such a massive door that we don't have time for in this discussion. But your good thought opponent on Twitter, Brent Johnson, has the dollar milkshake theory. It's actually been a good while since I've talked to Brent, so he may have evolved his thinking, and I may be unaware of it. But from previous conversations with him, he has said, well, look, a lot of those same issues are going to be impacting a lot of other countries as well. And, if there is a global recession, if there are hard times, a lot of countries are in even worse shape than us. And when people get scared, both you have the euro dollar dynamics that are pushing capital towards the US as euro dollar loans start defaulting or whatnot. But he would generally say, yeah, in times of panic, capital runs to safety. And even though there's lots of issues, are there better deep liquid markets out there than US treasuries? And, could a lot of the concerns you're talking about still get just sort of washed over by just panicked capital around the rest of the world flowing in rather than net selling our treasuries? What would your
capital's already here? That's the net. He's been exactly right. When I say the net international investment position of the U.S. has gone from negative 10 in 08 to negative 70, 2 years ago, that's the capital flowing here.
Okay, so you're saying that flight to safety has already happened. It's all here now.
It's all here. It's all here. We've been hawking our family silver for cheap stuff from China. So I think one of our primary disagreements now. He will say, well, relative to others, yeah, look, if you want to structure, like he will say the others are in more trouble. Yeah, exactly. And I totally agree. What are they going to do? Where our views disagree is, yes, others are more in trouble. What are they going to do? They need dollars. Yes, we agree. Okay, what are they going to do? They're going to sell their dollar assets. Like he keeps saying the capital is going to flow here. Yes, some capital will flow here, but on net, there is no capital to flow here. It's already here, and they need dollars. They don't need Apple. They don't need treasuries. They need dollars. And so they will sell Apple and treasuries and real estate, et cetera, to get those dollars. And you can see this unwinding in the other direction. Number one, you can see it in the net international investment position. Since 2021, it's gone from negative 70 to negative 65. So literally December of 21, it was negative 70. It's now negative 65. So just unwinding 5 points of net international investment position as a percent of GDP, look what it's done to the treasury market. Right. We had the worst year in the treasury market. We had the worst bond market in 150 years last year. That was 5 points. Now we have another 65 points to get back to where we were in Japan. The Fed breaks way before that.
Okay, great. And on that point, I want to share my screen here for a second with a chart that you tweeted out the other day. Can you see the chart here, Luke?
Yeah, full credit to that goes to Mike Green at Prof Plum. Bob Elliott retweeted that. It was a piece from a piece that Mike Green had publicly available over the weekend. But yeah.
Okay. So this shows what you were talking about. And it really, you know, it visualizes the sea change that's gone on here that you were just talking about. So is there anything else on top of this that you want to mention? Because you're right. I mean, right now, the Treasury market is, you know, it's revolting.
And it's going to keep revolting. The beatings in the Treasury market at the long end are going to continue until the dollars weaken meaningfully. Full stop. That's it. You weaken the dollar, Treasuries will get better. But if you weaken it too much, that'll create a problem too. But for the moment, the beatings in the Treasury market will continue until at the long end, until the dollars weaken meaningfully. To me, this chart, and I tweeted about it this weekend, this chart shows you when the U.S. went into fiscal dominance. When the market began, forget about when the U.S. went into fiscal dominance, this chart shows you when the market began discounting the U.S. going into fiscal dominance, which is the U.S. can't pay its debt without the Fed printing the money. Okay.
So, I mean, this is a big deal in the way in which you're portraying it. There's an old term from the 80s that we hadn't heard for a long time, but, you know, the bond vigilantes, right? It's when the bond market kind of wakes up and says, hey, you know, I don't really believe what you policymakers are selling me, and I'm going to start taking yields, you know, higher because I want to be compensated for the greater risk that I see in the system. And so, you know, basically that's what you're saying is going on here.
Well, I would add that I think, you know, when these two lines were running together, that's what the bond vigilantes are telling you, right? Now they're telling you the United States is Argentina, because what they're telling you is the rates are going up and U.S. government can't afford that. They're going to print the difference. So what do you do when structurally, you know, I'm not talking about making a trade for bonds here or there. I'm talking about you run $200 billion, you're a sovereign wealth fund, and the United States starts raising rates like that. And you do the math. It's not hard math. It's sixth grade math. Debt times rate times whatever else they're spending on times receipts. You make a pretty basic adjustment about the interest rate sensitivity of the U.S. government and their tax receipts. And you go, they can't afford those rates without printing the money. When you're running, you know, you want to run 200 million and you want to try to trade it. Hey, God bless you. Good luck. You're running 200 billion. You know what you do? You buy stocks. You buy stocks and you sell bonds, just like that chart shows, because stocks will hedge your inflation and bonds will get killed on a real basis. That's what that chart is telling me.
Okay. All right. Just to let you know, I'm only on bullet number 3 of like 15 that I.
We can go for a bit. We're good.
It's a sign of a great discussion. So, well, let me wrap a couple of questions together here. How much higher do you see him going from here? And let me kind of wrap into that too. How likely do you think it is that the Fed will win the inflation war? Right, because once the Fed has inflation down to 2%, it's got a lot more leeway, right? But inflation is still sort of sticky, right? I've sort of brought up the Pareto principle where presumably maybe the easy 80%'s been done. Now it's the hard 20, right? So inflation and knock-on effect of interest rates, you know, what do you think?
So do I think they will be successful getting back to 2? No. I think there's a reason why Jason Furman, who was Obama's chairman of the Council of Economic Advisors, is in the Wall Street Journal with an op-ed today saying the Fed should increase their inflation target to 3.
To 3, and just call it done. Mission accomplished.
And Paul Krugman saying, hey, it's a good idea to just go to 3. Mm-hmm. March told us they can't go to 2 unless they're willing to stand aside and let the banking system come unhinged and let the treasury market really dysfunction. And if they're not willing to do that, then they're not going to be able to they're not going to be able to get back to 2.
Okay, so just to be clear, do you think that we are in a secularly higher era of inflation looking out over the next decade plus than what Americans have been accustomed to for the past couple decades?
Oh my God, absolutely. Like, yes, 100
Okay.
times yes.
No brainer. Okay.
It's a no brainer, right? Like, I mean, there was an article yesterday in the Wall Street Journal, the 40-year run of China's economic miracles over. Great. Maybe, maybe not. Let's say it is. What's the correlate of that?
Right.
40-year run of Chinese disinflation to the US bond market's over.
Right. No more cheap stuff, no more cheap services. Yeah.
Yep.
Okay.
Yeah, exactly.
All right. So similarly on the cost of capital side of things, interest rates, they were talking, I think the 10 years, like 4 and 4.3% or something like that.
Yeah,
we're at 5.25%, like I said, on the federal funds rate. The Fed is guiding us that they're almost done, maybe even done cutting, but they're keeping the door open for at least one more rate hike. Do you think that that's likely? Do you think, nope, this sucker's going a lot higher for a lot of the issues that you mentioned at the beginning of the discussion here? Or, do you think they move the inflation target to 3%, mission accomplished, now we can pivot?
I think they probably go higher. And the reason I think they go higher, and it's ironic, it's going to ultimately completely discredit them. Raising rates is going to discredit them. But the reason I think that is I think they're losing control on oil now. Oil, I think, is going to go 85, 90, 100, 105, whatever. And I think with the easiest comps behind you, tougher comps coming on inflation, you're going to start seeing inflation pick back up. And the US has no ability to control it. Shale's rolling over. SPR, who knows where that is, but they've largely run that down. That's not.
And I'm sorry to interject, just to make sure we understand. Is your confidence that oil is going to go higher in the relatively near future? Are you tying that specifically to Fed policy, meaning the more expensive it is to borrow, the harder it is for drillers to drill? You've already talked about production's decreasing too, so that's making things even worse. But is it sort of a direct relationship between cost of capital and output? Is that why you're so confident that if they keep hiking, Shale's going to
go? I had a conversation with a friend of mine, graybeard, who was trading Eurodollar markets in the 70s. And he goes, Luke, what's going to be really interesting is when it starts happening. If they go too far, you'll get what you had in the 70s, which is, look, finding and exploring and drilling for oil is risky and capital intensive. There's a high cost of capital. And in an administration that doesn't really want you doing it. So if you're an oil producer, why go through all that hassle when you can just take your cash and put it in treasuries for 3 months at 6?
Exactly. Yeah.
I'm not drilling. I'll make 6% risk free. Except if they all start doing that, oil production is going to fall at 20, 30% a year in the US. And guess what? As bad as China is, China's oil imports are rising double digits. They're on set for another record year of oil imports. India's oil consumption, India's booming, is right. What I hear.
But that's all coming from cheap Russia supply, right?
Another own goal by the U.S. administration. Indian oil consumption is 1/15 of the United States. 1/15 with 3 times the population. China's is still only 1/5. And they're the biggest oil importer in the world. And the Fed is encouraging shale to not drill. And we're the biggest marginal producer over the last, it is not well understood that the US there was a gambit. Raise rates, strengthen the dollar, cap oil with the SPR, and hope Russia breaks before US shale rolls over and before
Right.
the US banking system breaks. And yes, Russia is hurting. Yes, the ruble's down to 95, up from 100, but it went down back to 100, whatever. Russia's not breaking. Shale rolling over is very inflationary, very inflationary. Deficits are inflationary. China's sort of the cheap stuff from China, deglobalization, all this, like everything is on one side of it, and everybody just wants to buy long-term bonds because for 40 years buying long-term bonds work. I don't understand it.
Okay. All right. Well, we're going to get in a moment to what you like. One thing I just want to mention on this whole shale thing, because it's another kind of nail in the coffin in terms of supply, is shale wells deplete asymptotically,
Yes.
unlike conventional wells, which deplete on a bell curve, right? So a conventional oil well has a much longer lifespan. There's this thing called the Red Queen syndrome where you're drilling for shale, where you have to keep drilling more and more to keep production where it is because your early wells are just asymptotically running out of supply. So it just means, to your point, like when we compromise production, it falls off much faster in a shale field than it would, say back in the 70s when we were having.
Or if you're Russia's oil production.
Right. Or if you're Russia's, exactly.
Which was a major flaw in the whole US policy. And it's fascinating, Adam. 9 out of 10 discussions I have with people on Twitter, etc., that want to buy bonds, they say, well, the US is the biggest oil producer in the world. And that's the extent of the discussion. Like, no, you don't understand the geology. What do you mean? They don't understand that geology. Most of these bond buyers don't understand that geology. If they did, again, it's that siloing, right? The oil guys are like, hello, McFly, there's a problem coming here. And the bond guys are like, no, deflation's coming. Great. Let me buy the long end.
Yeah.
And it might be a trade. There might be a trade there, but it's nickels in front of steamboat.
Well, and we've talked about this a lot over the years. I mean, you have people that kind of look at and the Fed's probably the most guilty of this than anybody else, but they look at the economy or certain elements as closed systems, and they don't look at them as the other systems that they depend on to work. So why is Luke spending so much time talking about the oil industry? Well, because without energy, you cannot power an economy. Right?
Right. That's exactly it. And that is a major, major oversight. And for a long, long time, dollars equal energy. Treasuries equal energy. And we are seeing in real time the disconnection between the dollar and energy and treasuries and energy. You're seeing people circumvent that, right? When China says, hey, we just signed a 27-year LNG deal with the UAE or with Qatar, excuse me. And then they sign a second one. Like the way the world worked from 1971 at least up until recently was China sells crap to the US sends dollars, China takes the dollars, they buy treasuries, and they hold those treasuries for a rainy day when they need to buy LNG. Right. Now what are they doing? They're going straight to the source and going, here, you take the dollars and you promise us we will pre-buy a 27-year supply of LNG. And then we'll do it again because we would rather own a 27-year supply of LNG in the ground than we would the equivalent amount of treasuries. They're telling you what's happening. Yeah. People just refuse to see it. And that then flips over. Well, who buys those treasuries? Fed, banks. Well, who buys them if the Fed and the banks don't? Nobody. The rates go up until we figure out who's going to buy them. Right. And we hope that that clearing rate doesn't bankrupt the US government. Oops, receipts are below true interest expense already. That's why I would say we're on the 7th, 8th inning.
So do you see us then, is the Japanification of the US inevitable at this point?
Yeah, but the Japanification of the US is going to feel like the Argentinaization.
Our interview with Luke will continue over in part 2, which will be released on this channel as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Also, if you haven't yet heard, tickets for the Wealthion Fall Conference have just gone on sale at the early bird price discount of nearly 30% off the standard price. And alumni of our previous conferences get an additional 15% discount on top of that. To lock in these low prices while they last, go to wealthion.com/conference. And if the challenges Luke has detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities Luke has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Luke Gromen.